Two stocks I'm buying in March of 2025. This is a video that I don't do very often, but I'm gonna share two stocks I bought the dip on here over the last week. I'm gonna give you my analysis on them, my valuation model, let you know my opinion and everything about them. And this is something I don't do very often. So if you do enjoy that stuff, all I'm asking is if you could please press the like button and let me know what you think in the comments. The first one, which is a stock I talked about many times, talk about it again. And this is Uber. Uber is down around 3% over the last year. It's still up 20% this year alone. And it has kind of, saved my portfolio. But even with the stock pulling back from the highs around 6 or 7%, I still believe Uber is one of the most misunderstood, one of the cheapest, most underrated tech companies in the stock market. And that's why I've been adding more to the stock whenever I can. It's not just about the price. People believe that if the stock is down 20%, that means now it's a bargain. But sometimes it's the price relative to the fundamentals. In the case of Uber, yes, the stock has gone up 20%, but the estimate, the multiple has gone down, the free cash flow growth has went up, and the fundamentals have been getting much, much better as the stock has been going up. So with Uber, I believe most investors, they still have a bad memory from when the stock went public in 2018 or 2019. They believe this is just a trash, money-losing company, whatever. It was losing $5 billion in free cash flow. Now it's going to make $8 billion, $8 billion in free cash flow. This is a massive, massive change from when Uber went public. My favorite part about Uber is this is around a $150, $160 billion company. They're already worldwide. They already have so many different things. But the growth is, in many cases, re-accelerating with the company. And this is something you don't find very often. Like, for example, monthly active users. They have 171 million monthly active users. That's a lot of users. And they increased 14%, which was a re-acceleration from the last quarter. Same thing with trips. Trips also re-accelerated 18%. Gross booking was up 21%. It's still holding up. Massive growth, 21% is insane for the scale of the company of over $44 billion on quarterly gross booking. In terms of the delivery business, it's still very, very strong. Re-accelerating again, 18% growth in gross booking. Revenue up 20% from 4% to 20%. This is insane. EBITDA margin from 2.8% to 3.6%. They also have a membership called Uber One with over 30 million members, growing 60% year on year. And this is a membership that gives people discounts, I believe free deliveries or other kind of benefits. And it helps a lot within retention. So it helps retain those people on the platform. And it's an amazing, amazing idea from the management of Uber. And the company, even though in the United States, is more of a household name. Like if you think about it, most people, they don't even say, I'm going to get a taxi. They say, I'm going to get an Uber. Or just order an Uber, call it Uber. They don't even say call it taxi anymore. They don't say call it Lyft. They say call it Uber. And Uber kind of became a household name in the United States. But there's many different countries around the world where Uber is not yet a household name. And this is where the company is expanding, and they're investing a lot of money there, including Spain, which is up 2x between 2021 to 2023, Japan 2x, Argentina 11x, Italy 4x, South Korea 10x, Germany 2x, and they've been expanding it. They said we're expanding in new countries where Uber is not yet a verb. This is just, amazing from the company. If we look at their partners for AVs, autonomous vehicles, they have many different partners. The most popular one is Waymo, which is backed by Google, or you could say Alphabet. They rolled out, I believe, this week in Austin, and this is only going to be available exclusively on the Uber app. And that's amazing. And if you think about it, the main argument around Uber is that autonomous vehicles are going to kill the Uber's business model. But you have something like Waymo, which is backed by Alphabet. Alphabet has tens and hundreds of billions of dollars. They can create their own ride-sharing app. They can do their own things. They can expand on their own. But they're still expanding with Uber. They're going to expand in Atlanta with Uber this year and in Miami next year with a company called Move, which is mostly owned by Uber. And this is because Uber has fleet managers. The fleet managers, they charge those cars, they clean them, they maintain them, they take care of the transactions, they take care of all these kind of things for a very small fee. So to most of those kind of AV companies, it makes much more sense for them to roll out their vehicles in new cities with Uber instead of them doing it on their own. And the second argument is, availability, because in a lot of those cities, Waymo, for example, is not going to have enough vehicles in Austin to meet the demand 24/7. People don't want to have 200 different apps, and they don't want to wait 2 hours for a Waymo. So what they could do is, okay, a Waymo is not available, I can get an Uber, all this in one app, with deliveries and so many different things. Even a lot of those robot kind of companies are partnering with Uber with robot delivery from a restaurant. It goes to your house, and drone deliveries. It's all going to be on the Uber app. That's why I say, Uber to me is like Amazon of ride sharing, Amazon of deliveries, the Amazon of autonomous vehicles, because it's all going to be on the Uber app and the Uber ecosystem. And Uber is going to collect fees, high recurring margin kind of revenues. And this is the vision that I have for the company that I believe the market is not appreciating yet, mainly because of Tesla's robo-taxis, which I said many times that they're going to be amazing, but they're not going to have 100% market share. And most companies are just partnering with Uber. Okay, and the management does believe that the stock is cheap. They rolled out a $7 billion share repurchase authorization program, and they've been buying back a lot of stock. Now, if I look at the multiple of Uber, it's trading at 19 times cash flow, 19 times price to free cash flow. This is dirt cheap for a company like Uber with the ecosystem, with the kind of retention, 171 million monthly active users. And considering the fact that free cash flow has been massively growing over 100% in 2024, expected 17% in 2025. I think they'll easily do 20%. They expect 24% 2026, 18% 2027. I think it's easily going to be around 19 to 20%. But even using those estimates, I'm buying Uber today below 1 times price to free cash flow growth. This is dirt cheap for a tech company, dirt cheap for something like Uber. And if I'm not expecting a multiple contraction, I believe 19 times is the bottom. I think the company will likely get a multiple expansion to 22 to 25 times free cash flow. But assuming the multiple stays the same, the company is able to grow 19 to 20% in free cash flow over the next 5-6 years, I would expect my annual return to be pretty close to the free cash flow growth of around 19 to 20%. But I'm personally expecting a multiple expansion to 22 to 25 times free cash flow this year, which would put my returns much, much higher than 19 to 20% a year. So even though Uber stock isn't down so much, for the kind of fundamentals that I'm getting, I've been adding to the stock, and I hope I get an opportunity to buy more below $70. And the management is buying back. I'm buying a little bit of the stock, and I just love it. Amazing opportunity, and I really hope the stock goes lower. The second one, which I talked about many times, so I'm gonna keep it short, and this is Amazon. Amazon is down 14% over the last month, down 9.5% over the last year, and something very interesting has happened. For the first time in history, Amazon's PE ratio is now below Walmart's PE ratio. This has never happened. Amazon's 33 times earnings, Walmart almost 37 times earnings, even though Amazon has higher margins, and they could have higher margins if they were not reinvesting in themselves. Amazon has much higher growth, a much more efficient business model, yet Walmart right now is trading at a higher multiple than Amazon, and that has pretty much never happened, and it's very interesting to me. Now, I posted this chart on my X account, and this is mainly the price to operating cash flow, which I believe is the metric that should be used to value Amazon, as their CapEx a little bit volatile, and they can kind of pull it back anytime they want, most of it except the infrastructure stuff. If the company ever gets to maturity, they decide to maximize profitability, they can easily pull back, in my opinion, 30 to 40% of the CapEx, making free cash flow looks extremely amazing. So I'm using price to operating cash flow. The average is around 25.5 times. Now Amazon is trading at 18 times cash flow. 18 times is very, very cheap for the company, considering that, for example, Amazon Web Services has bottomed out around 12%, and it has been re-accelerating in growth, 13%, 17%, 19%. It's re-accelerating in growth, and this is amazing for the company. And the operating cash flow itself is growing 81% in 2023, 36% in 2024, then 20 to 22% growth from 2025 to 2028. It's amazing for the company, and you're buying it at 19 times operating cash flow, and this operating cash flow is still growing 20 to 22%. So this is another case where we're buying Amazon below 1 time price to operating cash flow growth, and anytime you could get below 1 peg price to earnings growth, price to operating cash flow growth, and you believe the growth is sustainable, you're normally getting a terrific deal with those tech companies or growth stocks in general. And I expect, again, the return here to be pretty close to the growth of around 19 to 20% per year. But I see more upside with Uber. As with Uber, I'm seeing a multiple expansion. Once Tesla fears of the robo-taxis taking over, I see we could see $100 in the short term, and over the long term, 20% annual return. That's my base case on Uber. So I like Uber, I like Amazon. I bought both of those stocks this week in March of 2025. If you're interested more in what I do and how I'm navigating this market, I share everything I do in my own group. This is the link if you're interested. So thank you again for watching. Hope you enjoyed it. Not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.